I want us to look at International Accounting Standard 7, IAS 7. Let me ask you a question. Have you ever seen a company report a huge profit and yet they're struggling to pay salaries or to pay their suppliers? Well, I want to tell you that that is the exact reason why IAS 7 exists. IAS 7 is simple for exam purposes, for professionals, and for people who use financial information. I want to demystify IAS 7 in 3 minutes. Stay with me and go the full course. Good. Now, IAS 7 deals with statement of cash flows. And there are 3 segments. The first is operating, the second is investing, and the third is financing. So if you remember OIF, you'll never forget it. The operating activity deals with the ability of the company to generate revenue from its core activities. Usually we look at cash from customers, we look at what was paid to suppliers, cash that was paid to employees, and also we look at cash that was used for operating expenses. So basically this is what it is. So next we have the investing segment. The investing activities here, basically we're testing for growth. Okay, and we look at the PPE, that's the property, plant, and equipment that the organization, that the company has bought. We also look at the PPE that it has sold, and then we look at the purchasing or selling of investment. So this is what this segment is all about, the investing activities. You got some money, what did you use it for? Did you invest for growth? The last segment of the statement of cash flows is the financing. Here we look at how the organization is able to finance its activities. Is it from debt? Is it from equity? So we look at activities like issuing of shares. We look at loans, and we also look at the repayment of those loans. Remember that depreciation, amortization, and impairment are not physical movement of cash. Always remember that there's a difference between accounting profit and real cash. So IAS 7 does not focus on profit. IAS 7 focuses on real cash. That is the difference. So now there are also some adjustments, whether you are using the direct method or using the indirect method. But most importantly, in the indirect method, these adjustments are very, very necessary. And also an increase in receivables does not mean more cash. It means less cash, actually. So if you enjoyed this class, I urge you to subscribe and to follow this page so that we can treat all the international financial reporting standards one after the other.